Watson here. Welcome to week 14 of managerial finance. So this week we're going to be talking about stock valuation, and this is our third series of the time value of money series when we evaluate different asset classes. Stock valuation tends to be the toughest chapter through time value of money simply because we use so many different valuation methods. When we were going through simple time value of money concepts, it was just very straightforward. This is XYZ. This is the one method we use to value a savings account. With bonds, it was the same thing. With stock valuation, on the other hand, we use several different methods. We use the corporate valuation model. We use a constant growth model, a non-constant growth model. We use the dividend approach. We can use some ratio approaches like P/E or P to CF, which is price per earnings or price per cash flow. So there's a lot of different methods that we use. We use free cash flow in some of these. So this chapter takes a little bit more work, I think, than the others, but that's why I like to record this lecture, to kind of help you walk through why we use the different valuation methods. So this is very, very indicative of startup funding. So I run the Telluride Venture Fund, and these are the methods that I actually use to value companies. So this is like real life stuff here, actually working in real time. So as we kind of go through this, I'll try to explain how we use these different stock valuation methods, especially for startups. So this book really focuses on corporate finance and public companies, that have had an IPO, that are on the New York Stock Exchange, etc. But we actually use this in very small business, and especially with like a startup SaaS company. We look at their stock valuation and we say, well, how much is your company actually worth? And can you support your valuation, and how much is your stock worth? And that helps us go down a whole road of due diligence to help value a company. So that's what we're going to talk about today. Super thrilling stuff. It's actually very, very interesting, especially if you're in finance and especially when it comes to startups. And a lot of you may start your own startup someday, and you're going to run back into this material again. And you think I'm crazy for lecturing on it, but this is real stuff. So welcome to week 14. Welcome to chapter 9, stock valuation. So when we did our bond valuation, guys, with time value of money concepts, inputs in your calculator, bond inputs in your calculator, and then I've also kind of plugged in the discount or the stock valuation method for you as well. So I'm going to go ahead and pull that up real quick. So I will upload this onto D2L for you, but right here you can see that we have stocks in here, and you'll notice that I've just kind of plugged in the terminology that we're going to use. So your calculator input, the N is now what we call the year. Sometimes but we are going to ditch that maturity date name that we gave it with bonds. Your IY in your calculator is called your rate of return, and you'll notice in your book and your homework it's R sub S. So that's the rate of return that we're dealing with. Your PV is your intrinsic value, so we'll really talk about stock value today and intrinsic value. Your PMT, or that payment, is what we call a dividend now. So in bond valuation, we called it a coupon. In time value of money, we called it a payment, and now we know it as a dividend. And this is probably pretty familiar at this point in your business education. You know that stocks pay dividends, or you've heard something like that. So this chapter tends to be a bit more difficult, but students, I think, can relate better to it because a lot of courses talk about, Apple stock and all these big corporate companies, so you're a little bit more familiar with the vocab. And then future value, FV, is just future value with stocks as well. So I'm going to go ahead and pull up your lecture for you. Oops. That's not it. So this is also uploaded for you, and we're just going to kind of go ahead and move through this. We're going to talk about stocks and evaluation today. We're going to talk about some of the features of common stock, and remember, as we go through this, guys, we're talking about common stock today. We're not talking about preferred stock. We have all sorts of different types of types of stock in a company. But we're just talking about common stock. So this is the kind of stock that you're going to find on the market, that you could go to Apple, and if you bought Apple shares today, you would be buying common stock of that company. There's all sorts of different types of stock that we talk about. There's founder stocks. When you first start a company, It has different voting rights. You can own a bigger percentage of the company for a lower price. It's a more powerful kind of stock. We have preferred stock, which has higher rights. So like in a liquidation event, that preferred stock would get paid out before common stock. And then common stocks, like bottom of the barrel, these are just the common folk. Anybody can own this kind of stock. So we're going to talk about intrinsic value and stock price, the difference between that. There's a huge difference in the market and how we look at these two. So in this class, we're valuing the intrinsic value of the stock, but you'll notice that we're going to have a discussion about stock price here and really what drives that. And the stock price is that front-facing price that you see on the market, and it's driven by much different factors than our intrinsic value. We're going to actually determine the stock price. So the whole high-level 10,000-foot concept of this chapter is we're trying to find the common stock value, and we're going to use all sorts of different models to do that. So one of the models will be the discounted dividend model, one will be the corporate valuation, and we'll talk about a couple others, but those are really the two that you're really going to focus on. And then we're going to talk just very briefly on preferred stock. So facts about common stock. Common stock represents ownership in a company. So if you own common stock in a company, you now have equity and some form or amount of control in that company. So you have a say-so in that company because you have ownership, and that's what it represents. So you have control. So if you have, we talk about, if you've seen Shark Tank, they will, sell an investor or sell a company on, hey, I'll take 51% of your company for a certain amount of money. Shark Tank is as exciting as it is total BS because those guys are just hounds and they're trying to take a significant portion of a company's stock. And they're trying to take over control of that company is what they're trying to do. And a lot of times you'll hear outrageously high amounts of equity that these sharks want on Shark Tank. In real life, like in my job, that's not how it works. The owners really try to keep control of the company because they know the direction of the company. And investors like, the Telluride Venture Fund, we come in and we say, hey, we'll take 10% of your company for this amount of money, and we get 10% control in that company. And that's a pretty significant amount of control, but it's not majority control. So ownership implies control in a company. Stockholders elect the directors of the company, so that's a huge piece of power that they have. They basically direct the way that they want management and how the company should be directed. That's what their say is, and putting their money into a company. And the idea, again, of those managers is to maximize stock price. They're trying to create as much value in the company for the people who have invested their own money into the company. And then those directors, the stockholders elect the directors, but then the directors elect management. So it's kind of a tiered approach to it, but really the drivers of a company are the stockholders. And again, it's to maximize the stock price. A lot of people think that stock in a company is owned by just people like you and I. But when we're talking about the public market, big companies like Nike and Apple, they're actually truly owned by big corporations like insurance companies and people who have a lot of money. Different kinds of funds come in. So it's very uncommon to see one sole person hold a large amount of these big corporate companies. It's very common with startups, companies that are not public, that are private, to see individuals hold significant ownership in the company. But with the big companies that we're talking about here, oftentimes it's companies that own big shares of the company essentially. So we're going to talk about intrinsic value and stock price. You've probably seen the graphic that I'm going to show you next, and I'm just going to. So we have intrinsic value, which is here on the left, and then we have stock market price here on the right. So you'll notice that if we look up here and just break down intrinsic value, you'll notice that what drives intrinsic value is true investor cash flow and true risk. And when we say true, we mean that we're deriving the intrinsic value of a company from the numbers of the company. So this is the true valuation. Intrinsic means true. And this is what we are valuing in this chapter, the intrinsic side of it. So in a true investor cash flow, these are the real cash flows of the company built from our pro forma or maybe their historical data. This is the real numbers, the real money that the company has generated. And also the true risk of it, like the real beta that we calculate, like what is the real risk of this company by the numbers. So we really focus on intrinsic value. On the flip side of it, you'll see that we have stock price. Well, stock price is an outward-facing value that the public determines. And so this is the prices that you see go across on the ticker tape on, if you're looking at the Dow, if you're looking at New York Stock Exchange, whatever. This is the price that you'll see go across there. And the stock market price is driven by, this is largely driven by media. You could have really, really strong value in the intrinsic value of your company, but if the market gets scared because of some media news report or something, say we're talking about, I don't know, the energy industry, and some false news report comes out, that could technically sink the stock market price temporarily, but the company still has true intrinsic value. So it's kind of a double-edged sword. They need to work together. They're very important, both of them, both intrinsic and stock. But the whole concept here in managerial finance is that we'll always reach market equilibrium with intrinsic value and stock price. That's not always true, though. We want them to be very close because that means the market is in equilibrium. But sometimes, for example, I'll give you the example of an IPO. An initial public offering, the intrinsic value of a company could be very strong. Like Facebook, for example, when it first came to the market for an IPO, they really thought that Facebook was going to take off. They thought that it was going to hit the market and the stock price was just going to significantly increase. And while Facebook really did have value when it hit the market, it had good intrinsic value, the market did not respond positively to Facebook when it first hit. And so they basically bottomed out their stock price. So, I can't remember exactly what the stock value was, but let's say that the intrinsic value of Facebook was $2. And when it hit the market didn't respond favorably to it. They didn't think that Facebook was going to be successful. They were still on the MySpace bandwagon. And let's say that the stock price was 25 cents, okay? It doesn't mean that Facebook didn't really truly have value and still doesn't have value. It just was how the market was responding to it. So the stock price can be very, very volatile. And that's why we look at intrinsic value, because that's the true number that we go off of, both in the public market and in the private market when we're looking at startups. And you'll notice at the top of this graph, we have all sorts of actions that affect both of these. And that is true for both. Managerial actions could significantly affect the true intrinsic value of a company. They could make a poor management decision that could lose the company equity or intrinsic value. The management action could also be poorly or positively perceived by the public, which could significantly affect the stock price. The economy always affects both of them. The economy, if we have a recession, everything decreases, all the stock prices decrease, but that doesn't mean that the companies necessarily lost intrinsic value, or maybe they did, depending on what kind of sector they were in. Taxes and then the political climate also has a significant role in that. When we went through the last election, when the Republican Party got into office, because the frontrunner was a businessman, we saw very positive effects in the market, and it was predicted that had a Democrat got into office, the stock market would have decreased. Now, that has nothing to do with what kind of economic policy might have been passed. It had to do with the perception of the stock market and the fear of people, or the bullishness of the investors in the market, on how they thought whichever presidential candidate might have got into office, how it might affect the markets. So that was truly just driven on fear, or how bullish somebody was being in the market at the time. So here we're really going to focus on intrinsic value, but keep in mind that stock value is also significantly important as well. And the idea is that they always equal each other, but oftentimes they don't. Oftentimes we have a little bit of a discrepancy. In a really bear market or a really bullish market, you'll see that there's a greater discrepancy there. And that just kind of depends on what's going on. If the market's feeling really hot, if the market's feeling really cool at that point. So we have a couple different approaches that we're going to talk about. The biggest that we're going to talk about are the discounted dividend model and the corporate valuation model. We'll also talk about the PDE multiple approach, that's price per earnings, and the EVA, which is economic value added approach. But you're not heavily tested on the last two, but they are good to talk about. Well, you're very familiar with this. This discounted dividend model just holds a constant dividend, a constant growth, a constant return, and it gives you your intrinsic value. And you'll notice that this model is the same that we used for bonds. It's the same that we use for time value of money. So the constant growth model is really, really good for very strong, mature companies. So these are not our companies that are scaling. These are not our startups. These are not the ones that are, hitting a new market. These are our Johnson & Johnsons. These are our Nikes. These are our Apples of the world. And they're constant. And what we know is that the growth rate is going to be small and it's going to be constant. And we know as stockholders of these companies that we are going to earn a constant stock, are going to have a constant stock valuation, excuse me, and we're also going to earn a dividend. And if I didn't explain it, a dividend, you invest in a stock and you pay whatever the market rate for that stock is, and then you receive a dividend. Maybe it's a quarterly dividend, maybe it's a yearly dividend for every share of stock that you own. So it could be 25 cents a quarter, $1 a year, whatever it is, but it's just an additional incentive for you as a stockholder to get involved in that transaction. So you'll notice here that if we have a constant discounted dividend model, that we can value the dividend. Let's look at this one here. The dividend in year one is valued by taking the dividend today and multiplying it by 1 plus our growth rate to whatever power or whatever year that we're in, right? So this is very, very standard. We use this in bonds. And it also converges down here. If this makes more sense to you, the intrinsic value of your stock today is actually the dividend in year one divided by your rate of return minus, there should be a minus here, I'm sorry, minus your growth rate. So this is the simplest form of the dividend or discounted dividend model for you. But the thing with the constant growth model is that your G has to be constant. If you have any kind of like abnormal growth, supernormal, whatever you want to call it, if the growth is not constant, you can't use this model. So this is the formula right here. My P, remember that means my present value, my intrinsic value. Anything sub-zero means today. That equals my dividend in year one divided by my rate of return minus my growth rate. So here is a visual for you if you're a more hands-on kind of visual learner. And this is a great little slide here because it says, what happens if my growth rate is greater than my rate of return? Well, if your growth rate is greater than your rate of return, you can't use the constant growth formula. Why is that? Because that would lead to a negative intrinsic value, which doesn't actually make any sense. We can't have a negative intrinsic value necessarily. So if you notice a problem as you go through your homework and you see that your growth rate is greater than your rate of return, we need to use a different model. But for right now, we'll just assume we're using our dividend discount model and that our rate of return is not greater. So one thing, and you'll probably notice this from time value of money and bonds, we can calculate, we're not always given our rate of return, but we might be given some information in the question to. So I told you that on your cheat sheet that your rate of return is R sub S. And that's actually calculated by taking the rate of return on a risk-free asset. So a risk-free asset, for example, would be like a bond. So the rate of return in this question on a risk-free asset is 3%. And we're going to add that to the rate of return on the market. So the average market is returning 8%. And we're going to subtract out that rate of return on a risk-free asset, so your bond again. We're going to multiply that whole thing by the beta of the company. And remember, the beta means risk. If you go to, a stock quote on Yahoo Finance, Google Finance, you'll notice that there's B, and that means beta, and that means risk of a company. So, anything over 1, remember 1 is the market, and that's as risky. So if my beta of a company is 1, that means that my company is as risky as the market. So it's a pretty good middle ground place to be if you're as risky as the market. But that's determined on a lot of factors, like the market could be significantly risky, it could be less risky. So if I have a beta over 1, that means that my company is more risky than the market. So in this instance, the beta is 1.2. So my company is more risky than the market. Now let's say that my beta was 0.9, which is less than 1. That means that my company is less risky than the market. So the security market line simply is just a chart of your rate of return. And it's also a calculation that we use to calculate the rate of return if we don't have it in a question. So this is kind of a multi-step approach here. So this should look pretty familiar to you. This is our discounted dividend model. So what it's saying is that our dividend today is $2 and we're going to grow it by a constant 4%. So 0 means today, and in year 1, we went from $2 and we grew it by that 4%. And our dividend went from $2 today, and in year 1, our dividend will be $2.08. And then to get to our dividend in year 2, we took that $2.08 and multiplied it by our growth rate of 4% and got $2.16 and some change. So you'll notice here that this is the same thing as your time value of money, same thing that we did with the coupons on the bonds. And all we're finding out what is that $2.08 in year 1 worth today. It's $1.90. And you'll notice that our R right here is our IY in our calculator, so go back to that cheat sheet if you need it. But our rate of return on this stock is 9%. So all this information was given to you in this question. Some questions you may have to use your security market line to calculate your rate of return, but you're always given a growth rate. You don't have to calculate your growth rate, but you might have to calculate your dividends. You may not be given your dividends in these questions. And the growth rate seems to really throw students off. It's very, very simple. It's just a straightforward growth calculation. So take your dividend, $2, and grow it by 4%. And that's how you get that $2.08. So that's just the constant model that we've used to find out with a discounted model what the value of our dividend, our coupon, our payment, what's the value of it today. So we're taking a future value and bringing it back to today's time, and that's where we get that discount concept. So what is the stock's intrinsic value? If we're using the constant growth model, this is the easiest method that we'll use here with stocks. And if our G is constant, it's a very, very simple calculation. So we can find out what the value of our stock is today, and we can take our dividend divided by that rate of return minus our growth. So if we go back to the first example here, we knew that our dividend was $2 today, okay? And we grew it over the next 3 years. We grew it by 4% to find out what our dividend every single year was, right? So this is whatever this value of my stock is. My stock is paying a $2 dividend today, probably an annual dividend. And then in year 1, I would get $2.08 for my dividend. I would get $2.16 in year 2, and so on and so forth. So this is the very, very simple model here. So what this is really telling us is what is the actual intrinsic value of our stock today, just like what we did with bonds, but we're talking about stocks now. So for my previous timeline, I'm going to find my intrinsic value today, remember sub-0, by taking the dividend in year 1, so the $2.08, plugging in my rate of return of 9% and my growth rate of 4%. And when I consolidate all this down, I find out that the true intrinsic value of my stock today is worth $41.60. And I get paid a dividend of $2 this year. The following year, I'll get paid a dividend of $2.08, and so on. But really, what we're trying to answer, regardless of any of the methods that we use, we're trying to find out what is the stock value. So that's the easiest one. So it says, what's the stock expected value 1 year from today? So remember, you can use the same exact formula. You just have to change your sub-numbers here. So if I want to find out what my intrinsic value of my stock is in 1 year from today, I need to be using the dividend for the following year. So remember, these two always work one step with each other. So my intrinsic value today, I have to use my dividend for the next year. So if this is 0, this will be 1. If this is 1, this will be 2. If this is 2, this will be 3, and so on. So if I want to find out what the intrinsic value of my stock is in year 1, I'm going to use the dividend from year 2. And if you go back to that timeline a couple slides before, we grew our dividend, and so we knew that in year 2 that our dividend would be worth $2.16. So our rate of return and our growth rate still hold true, and that's a minus. Your book probably has that written out better. So we're going to subtract these two, and we find out that our present value or intrinsic value of our stock in year 1 is worth $43.26. The previous year, our stock was worth $41.60. So that's appreciation of value there. And as long as you're having positive growth in your company, you should see that intrinsic value trending upwards. You could also find this if you wanted to. You can use this formula. You could have also found it this way if you wanted to as well. And simply what this formula did is it took the present value from last year and it just applied the growth rate. So with the constant model, you can do that. The rate of return doesn't have I guess, as much effect there, but you could use the growth rate if you wanted to do that as well. But I suggest using this. This is what you get tested on. You get tested on that present value, or intrinsic value, excuse me. So another way that we can find the total return, you'll notice that we have a lot of separate calculations to find what our total return or our rate of return is for different stock problems. One of the ways that we can do that, we can use the dividend yield and the capital gains yield to find the total return of our stock. So we already told you, if you look down here, forget the dividend yield and capital gain yield right now, but we told you earlier that your R, or your rate of return, was 9%, right? Well, how in the world did we get that 9%? Well, we did it by using the dividend yield, and your dividend yield is simply your dividend in year one divided by your current intrinsic value today. So you'll kind of notice a couple familiar figures here. You notice that $2.08 divided by the $41.60, which was today's value essentially of the stock. And that would give you a percentage of 5%. So that's your dividend yield. And your capital gains yield is simply the intrinsic value in year one minus your intrinsic value today divided by your intrinsic value. So these numbers should look super familiar because we just calculated them. And that would give you a capital gains yield of 4%. So the 5% is my total dividend yield, how much I'm earning from my dividend, and the capital gains yield is how much is it actually appreciating, essentially. So when I add them together, that's the total return on my stock. So it's just another way to determine what your total return is. Now let's assume that I didn't have this nice constant 4% growth. What would the expected price be if I didn't have a growth rate? If I wasn't experiencing any growth, if my company was stagnant for some reason? Well, instead of growing that $2 today, that was $2.08 and $2.16 and so on, I'm not experiencing any growth, and so it's just $2 and $2 and $2 and $2. And as a stockholder, that's not necessarily a bad thing because you're still, getting paid a dividend, but it doesn't mean that you're actually increasing any value, that you're not getting any appreciation from your investment. So this equation that we were using earlier actually becomes much more simple at this point. And you'll recognize this equation from bonds when we talked about a perpetuity. And this is exactly what that is. It's a perpetuity. It's the same payment that's guaranteed into foreverness. So we find the intrinsic value of our stock by taking that payment of $2 and dividing it by our rate of return. So we completely exclude the growth rate in this question because we don't have one. And so you'll notice that our value with that constant growth model, the value of our stock today was $41, but if I'm not experiencing any growth, the value of my stock is $22.22. So 4% as a constant growth rate may not seem very high, but if you look at the intrinsic value of the stock, it's significantly high and significantly important if you're not actually experiencing any growth in your company. So that's just our dividend discount model, straightforward. It's the one that we've used, that we've been using the entire semester. This is where stocks get a little bit trickier. So it says, what if we have supernormal growth? And you'll notice that if you follow your rate of return and growth rule, if my growth rate is greater than my rate of return, I have to use a different method. Well, this is where that method comes into play. So what if my growth rate is 30% for year one, 20% for the next year, and 10% for the year after that? And then all of a sudden I achieve a long run growth rate of 4%. So you'll notice that we bring that 4% growth rate in, but the 3 years before that are supernormal or abnormal growth, okay? They're not constant. So we can't use the constant growth model anymore to find the stock value. We have to use a different valuation. So this is kind of a two-part series here. The first part, we are going to value the supernormal growth of our company, and then we can go back to that nice equation we were using previously with the constant growth and use that as we go forward. So you'll notice that this has already been worked out for you, but I kind of want to walk you through how we got some of these numbers. So you'll notice that everything holds true. Our dividend today is still $2. Our rate of return is still 9%, but you'll notice that that growth rate varies. So what we did here is we took our dividend of $2 and we grew it by 30%, and that's where we get that $2.60. And then in year two, we took that $2.60 and we grew it by 20%, and that's where we get that $3.12. And then in year three, we take that $3.12 and grow it by 10%, and that's where we get that $3.43. And after year 3, this is an important concept for you to grasp. This is what we call our time horizon. This is when we start to experience normal growth. So from sections 0 to, or years, I'm sorry, today to year 3, we have supernormal growth, and this takes a different valuation model. We're going to discount this section of this problem here. But after year 3, after our time horizon, or time value, or horizon value, excuse me, we experience constant growth of 4% from year 3 to forever, however long that stock goes on, however long that company is in operation. So we take that $3.40 and we grow it by 4%, and that's where we get that $3.56, okay? So this should look pretty familiar here. This is our time value of money. This is our bond valuation that we did. So what we have to do for this supernormal growth from today into year 3, we have to individually discount each of these dividends into the present time. So in this question right here, we would be taking $2.60, plugging it in to find the present value in our calculator, and that would be $2.38. So let me just walk you through this one real quick. If I was going to find out what the value of my $2.60 was today, remember that's the value of it 1 year from today, I would plug this into my calculator as follows. My N would be 1. My N would be 1. My IY would be 9. My present value, or PV, I'm just going to skip over because that's what I'm trying to calculate. My payment is going to be 0 in this question. I know that it's a dividend, but remember when we individually discount any of these, we just put in 0 for that payment. And then my FV in my calculator, my future value, is going to be that $2.60. And then I'm going to compute for my present value, and that's where I get that $2.38 there. So we're going to do that for years 1, 2, and 3, okay? So we're going to bring them back, just like this, plug them into your calculator. So, and the only thing you're changing in those questions is you're changing your N, and you're changing that future value, okay? And so once we found the intrinsic value of those 3 years, we've got the first part of our problem done here. The last part of our problem is we just valued the supernormal growth, but now we need to value the constant growth of our company. So you'll notice that the equation that we were using previously comes back. And the way that this equation breaks down is we are trying to find the intrinsic value, or the time horizon, or horizon value of our company in year 3. So what we're going to do is we're going to find out the value of it in year 3 by using the dividend in year 4. So that's why we had to calculate out this dividend in year 4 with that growth rate of 4%. And we're going to take that rate of return and we're going to subtract